back. You're still watching The Money Show on ET Now, and time to talk about the debt market. And for that, let me welcome in Amandeep Chopra. He's the President and Head of Fixed Income UTI Asset Management Company. Amandeep, thank you so much for taking time out and chatting with us today. So tell us, why does a fall in bond yields, what exactly does it mean for debt mutual fund holders?
Fall in yields clearly does impact debt funds who are relatively higher on duration because of the capital gains. So the price of bond rises with every decline in interest rates, and that helps investors gain not only from the income accrued because of the coupon that they receive on the bonds they hold, but also on the price appreciation. So the combination does increase the overall returns for an investor.
What is the fall, when it comes to the bond market, and given the current environment where the fear about money, or rather fear about economy slowing down, interest rates are also expected to be slashed, yields are already falling. How do you recommend retail investors shuffle their debt mutual fund allocation?
So I think in the current environment where we feel slowing economic growth with the declining inflation is quite positive in terms of the interest rate outlook. We've already seen rate cuts by RBI which have been transmitted into the fall in the yields. The recent measure to increase liquidity through LTROs is also quite beneficial for lowering the broader yield curve for both sovereign as well as corporate bonds. So this clearly does help investors who can look at investing in category of funds like money market fund, short-term income funds or corporate bond fund, as well as the medium-term fund. These funds typically run average maturities or modified durations between 2 to 3 years and can benefit from the capital gains which will arise when prices of bonds move up with the decline in rates. I think going forward, the interest rate environment will remain quite benign. This I think will also lead to a potential further easing or a rate cut by RBI, and that can also be then a benefit for the funds which are running modified durations, like I said, between 2 to 3 odd years.
Within the wide spectrum of categories like debt mutual fund has ultra short term to gilt to dynamic bond, what kind of fund do you think would be poised to perform best given the current macro environment?
So I think from our perspective, the product categories which can benefit in the current environment clearly will be the short term income category and the medium term category. These typically do not run such a high duration that even if interest rates decline and sort of bottom out, you don't really see any downside if, let's say, interests were to go up sometime, over the next few quarters. On the other side, the biggest impact of any rate decline is clearly felt the most in the gilt funds. But given the volatility in the yields, as we have seen both in the last 12 months and also on the year-to-date basis, there is a fair amount of day-to-day and monthly volatility in funds like gilt funds, which typically run modified durations of over 6 years. So the right way to actually allocate your money to benefit from both volatility and the decline in rates in a gilt category of funds would be to possibly do a systematic investment plan. So maybe allocating some money over the next 12 months in a gilt fund, would be quite beneficial for investors. But for investors who wish to do lump sum investments, for next 1 to 3 year period, I think the short term income category and the medium term category right now is best positioned.
Let's talk about the recent proposal by SEBI to build a liquidity buffer for debt mutual fund schemes. How would it protect debt mutual fund NAVs?
So in the basket of mutual fund products in the fixed income category, you actually have a subcategory called liquid funds. Now these are funds where you typically invest for a period of 7 to 30 odd days, and is largely used by investors for liquidity management. So for this particular category of funds, SEBI has recommended that the fund maintains adequate liquidity buffer, which is in the form of keeping at least 20% of its assets under management in highly liquid or liquidity equivalent assets. So which essentially means that even if there are very large outflows from this product category, because this product category is also very actively used by institutional investors, then the fund does not face any challenges in meeting those redemptions, and at the same time does not have to resort to very aggressive or large scale selling of its portfolio to fund redemptions. So I think that is quite beneficial in de-risking large inflows and outflows in this fund category. So two measures actually. The first measure which was undertaken by SEBI was in imposing an exit load for this fund. The exit load period lasts for 7 days. That also reduces volatility of fund flows in this fund. And the second, the liquidity buffer, which will become active from 1st of April, will also help the funds manage large inflows and outflows in the because of large institutional investors.
All right, Amandeep, thank you so much for taking time out and for chatting with us about the debt market and how debt mutual funds are likely to play out going forward given the macroeconomic uncertainty. With that, once again, slipping into a short break, we'll be back with the Spend Your TMS segment on the other side. Stay tuned.